Hello ladies and gentlemen, and welcome back to a very special weekend video talking about markets around the world. It's finally happened, the 200 simple moving average, the level that was synonymous with the US stock market and lows in 2018, 2016, and 2011. Even during 2020, we saw a big recovery for part of that week with strong demand coming back in. And that's exactly where we are now, nestled between the 200 simple moving average and a key zone of a very serious structure point. So do we despair at this point like everybody else is? Do we freak out, or do we start to focus on the smaller time frames? Well, the good thing about a new low is we now know where key market supply is. We now have a level that we can pinpoint in the future where if the market does go above it, we can start to really make a case for a small bullish turnaround. It may not be the biggest one, but it certainly could offer opportunity. So let's talk about it all right now, everything for the week ahead, and something that has just made massive history, a sentiment survey for the Times. Well, welcome back everybody to the Daily Show. We'll begin by talking about some really lead indicators in terms of bearishness, and then we'll talk about, of course, the macro data, go through the charts and the key levels that we should be watching right now. Well, we've all just witnessed history. 60% negative bearish readings on the survey of the AAII Sentiment Survey weekly. This has been done now for 1,800 weeks since 1987, and they've never seen a reading quite like this one. Yep, it's showing you that people are freaking out, and rightfully so. We're on new lows. The market doesn't look like it's stopping right yet. And while you might speculate that there is a key zone below, what we'll be looking for is some form of confirmation. Let's talk about smart money versus dumb money. Now, this indicator has often shown us a couple of key turning points in markets, or at least around key turning points in markets for 2022. What you'll notice here is dumb money is near its lows underneath the 20, and smart money is near its highs at the 80. So that means that technically smart money's been buying a little bit in here and accumulating a position at the lows, and dumb money has been dumping into that. Now, when we've been this wide, we've seen technical bases starting to form. Here was the one back in March. Here was the one, of course, that we saw that began that initial rally. Now, both of these were very important because they help us to say, okay, here's one piece of the case potentially to say, well, maybe there will be a counter over the next coming weeks. We've also seen one of the worst 60-40 portfolio percentages in 2022 out of all of the years ever that we've got here on track. 2008 is only now just beating it in terms of how bad the performance really has been between bonds and growth assets. Extreme fear on the fear greed index gauge, which of course takes into account a whole bunch of different indicators. And now let's get into the options discussion. We already know large options traders are establishing record hedges in the markets. It's a record low, and in comparison to other crisis periods, this is just so many more options than ever before. But what's interesting is we've just hit a big stat. Options traders are now spending a bucket load on protection. All retail put options premiums as a percentage of the US stock market capitalization. 4.5% back in March 2020. Well, we all know what happened then. September 23rd, 2022. Obviously, it's probably worse now. It was a reading of 4.5%. And now, October 10th, 2008, we had 5.4. So we're getting close to an extreme level of just so many people having bearish positions. And this can often lead to some very interesting capitulation kind of occurrences here in markets. It's something we've got to be very, very wary of. The third week options expiration in October is going to be key. Almost every big tech stock is just super down on breadth. In fact, almost nothing's above the breadth indicator here. And you can just see that again, once it's flatlined, often that can be a turning point in markets. If we've seen deep oversold territory, the next couple of weeks can become slightly bullish. Then it becomes quite unclear. And then historically, it's been bullish out of that with a capitulation coming back into markets. Now, what do we mean by capitulation? It means usually a very high VIX, usually a VIX over 45 plus, and we'll discuss that a little bit later. Once you get one of those levels, you can start to stack the odds in your favor and say, okay, wait a second, did we just see a super mega low formed in fear? Sub-industry groups in bear markets, another reading that's showing you an extreme high here. Again, not good for these markets, very sick indeed. But let's start talking about some other lead indicators coming into the seasonal approach to markets out there. Is there any hope for October? Well, in technically these types of years, which of course are the midterm elections, yes, there is. In fact, just in any of these years, when we've had a bad September that's down over 7%, which we have in 2022, we've tended to bounce except for 2008. It got even worse. That capitulation came through, and that's where a lot of those bad readings come from. What else do we know right now? Well, we know that the US dollar, everybody's going from, yeah, we're freaking out about the markets, again, potentially rightfully so, to going into the US dollar. And the US dollar is on a freight train at this stage. Now, it has faltered as we reported on last week, and the stats are horrific over the next month from some of the readings that we've seen in the past and what happens to the US dollar after this reading's occurred. So, do we continue to see weakness in the dollar and therefore potentially a turnaround in the stocks? Well, of course, seasonals would have you guess yes. The start of the October week turns the markets historically. Now, it doesn't necessarily in non-midterm election years. We see October continue to do poorly, but it is a very interesting stat indeed. And remember, this market's been following the rule book this year. The middle of August, that's exactly where we sold off. We've been following this concept now, along with other concepts, all the way through that September period until we hit the recent lows. What about over here? What happens during bear markets? Here's over 200 years of data if you're interested in checking it out. And of course, you can just pause the video if you want to watch that. For value hunters, for people that are trying to find some form of value, buying stocks at their lows, are they there yet? Well, a few people have criticized me for using the Russell one the other day. Remember, the Russell 2000 stocks are absolutely on their knees compared to the large companies. And we just saw Apple get obliterated last week after coming out with a bit of a demand warning. Are we cheap? Well, historically, not really. We need to get back down into those 13s or even 14s. And at this stage, at the time of recording, we're sitting about 15 to 16 PE in terms of the forward PE. Some people don't like that reading for figuring out cheap stocks, but I still think it gives you an average concept. Remember, to get back to 14 or 13, the SPY, the Sp500, is probably going to hit around a 3,200 to maybe 3,300 area. That's going to be a very pivotal point, and we'll take a look at it later on. What about S&P 500 stocks above their 200-day average? Another super critical low. You can't call the bottom here, but you're certainly starting to look for it. You've got to remember that Buffett saying of course, being greedy when others are fearful. It is important when you're considering these markets, and you just have to think about it. And of course, hopefully you're going to be correct when you do eventually make that decision. A lot of traders, a lot of investors want to find the key turnaround zones though, and at least get some confidence and stats in their place. And we'll show you those as we jump through the charts today in terms of some key levels that we believe are technically potentially setting up here on the charts. First up, let's take a look at the VIX. Has it hit peak fear this year? Not really. It's actually quite low. It's sitting underneath 35. We haven't seen one of those big 45 plus readings. And historically, that has usually meant that the market hasn't capitulated yet. The market hasn't gone, really freaking out and trashing on everybody at this stage. If we think about the Friday session, what happened? We saw yields go back up again. This is the story so far in 2022. It's inflation, 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 and now it's inflation and currencies. And it's pretty wild. It's like every currency in the world is trash except for the US dollar at this stage. And that is all people seem to want. And it's basically a war of now the Bank of England and probably going to be, Europe realistically, and possibly even other Western nations and other nations around the world coming in to support their own currencies as every single person bails on what they see as risky assets. But anyway, the US 2-year is quite high, 4.283 for the US stock market to face some form of recovery or see anything at all. We're going to need this to turn around. And that just hasn't happened yet at this stage. So let's now take a look at bonds. What are bonds telling us about the markets? A lot of people don't look at these. High yield bonds told us a few weeks ago that we were going to a painful kind of area. And so far, so good. The high yield bonds have continued to weaken, which has, of course, meant that the stock markets are freaking out across the world. We've also seen corporate grade bonds, that is investment grade bonds, go lower as well. Another worrying sign. But do notice the volume has increased strongly as it's bouncing around here. There's obviously some buyer coming in to meet that seller's demand. Is that an early pig? Somebody that is prepared to get into the market before others see the opportunity. Volume is showing big transactions going through there. And I think a lot of that's got to do with, of course, the Bank of England and just a lot of people positioning on what they believe is risky and what they believe is safe. Let's talk about interest yields again. TLT would have us believe that we're at a critical point. This is 20-year Treasury bonds. And as we saw before, the 2-year and the 10-year yields are so high right now. Inflation's high, yields are high. We've got big data coming for the US though this week, so that may change things. And TLT is at that key demand. So realistically, do people have a go at this kind of zone? Well, we're looking underneath and we're starting to see a little bit of structure. See how the market is coming back. And I kind of like to see it fill this gap down here and potentially bounce. If it does start to form a base, it could be a good sign that potentially yields may be going down, but also on top of that, we're getting Treasury bond turnarounds. Let's now talk about the US dollar, the best currency in the world right now for all the US citizens. Yeah, it's probably time to travel, guys, if you can, because damn, you'd be getting a good price everywhere around the world. I'm sure anyone watching from other countries is a bit jealous of how good the US dollar is going right now. I know I am here in Australia. Now, let's think about, though, what's going on with the US dollar. Well, it's kind of gone down. It's made a new peak and it's pulled back. There could be a little bit of strength here coming into the US dollar temporarily, but I'm believing at this stage, there's a good chance it comes back down into this level, that 110.50 to 110.25. And if you remember when we were talking about this, a lot of it has to do with mean reversion. This market is quite far, was extremely far away from its 20 moving average on the daily. And if you look at the weekly, it's pretty horrific. It's on a vertical ship to the moon and it's quite far away from that mean reversion. So this is a fairly pivotal point. Dollar index, a little bit of potential strength, but then we're overall turning into hopefully some weakness that gets us down to that 20 moving average on the daily and the 110.50 to 110.25. So what does this mean for currencies around the world? Well, I wanted to come over here to the euro US dollar, and this is a good proxy if you want to trade the US dollar in terms of the dollar index. That's usually what it kind of moves off. So we can see here that the euro hit our first level of supply. Very nice take profit. The turn here was pretty simple last week. And I've got to say, currencies and gold were certainly the better trades over the last week than the US stock market, unless you were just randomly short or you went short on that pin bar rejection to the downside when it went to that 37.20, 37.30 area. Here is a fairly good level of supply. If we breach that zone, we probably move back up here to around that 1 level. So parity back for the euro. But yeah, it's just hit that supply, which we had in our previous video. And this looks like it could short off a little bit here. Maybe make a move down to 97-ish. Maybe find some buyers there. I'd be looking for potentially the breakout this week with the further move on, because of course that would mean that the US dollar is weakening. And if that occurs, where's the US dollar going to? Ideally that 110.25, 110.50. And then this would be going towards that 100 kind of level. I mean, these are all just potential ideas in terms of the technical charts. Now we've seen gold weaken off that supply zone. So the first little area here got hit, small sell-off. We've just hit the second zone, and this is a critical one. Look how many times this was touched. No doubt there are some big players in there trying to short this one down. And yeah, it's a very, very key zone. smaller time frames, you're looking for schematical kind of entries. If you're interested in those things, you can always think about joining our class over at fxevolution.com. We do talk about these smaller time frame schematical entries and how to get, kind of, best